I'm Diane Rosignola, here at REIT Week, NAREIT's 2019 Investor Conference. I'm here with Doug Kessler, President and CEO of Ashford Hospitality Trust. Hi Doug, how are you?
Good day. Fine, thank you.
Ashford recently made its first direct hotel investment in New York City. What is it about the metrics of the New York market that prompted that investment?
Sure, so we've been looking to invest in New York City for some time, but the timing of investing in the market is critical, and we felt that we timed it just right. So some of the things that we look at are supply, demand, RevPAR, etc. What we saw is that New York had experienced pretty stable occupancy, but what changed is that there was a rebound in average daily rate, and that attracted us. Profitability of New York hotels was also improving, which we found compelling. On the demand side, we saw that there were certain infrastructure changes that were meaningful. First of all, the airport expansion at LaGuardia, the Javits Center, and the Hudson Yards, all of which we anticipate to create additional demand for this property. This is a very unique asset in the market. It's a property that is the only Embassy Suites in Manhattan that we acquired, and very efficient box. We felt that we bought it at a price per key that is below current replacement costs. The stabilized yield on this property we expect to be very attractive at approximately 8%. And so overall, it's a very good investment opportunity in an excellent location in Manhattan. It's just south of Times Square and Bryant Park. And so long term, we are very confident in the future success of this investment opportunity for Ashford Trust.
And turning to acquisitions, what sort of transaction volume are you seeing in both single assets and whole portfolios?
So last year, 2018, was a very good year for the hospitality industry. Transaction activity was up about 41%. But for the first quarter of 2019, it's been slower. In fact, transaction activity is down 31%. And so the types of decline have mainly been in the portfolios, a reduction of 74% in portfolio level activity. Meanwhile, single asset sales have been up about 3%. The good news is that overall prices are holding up. Cap rates for hotel assets have been approximately 18 basis points tighter, and per key values have been about 8% higher. So overall, even though there's fewer transactions available in the market, pricing is holding firm. Now, what's interesting for us and what's a compelling advantage is that we have something called the Enhanced Return Funding Program, which is an arrangement that we have with our advisor. It's a $50 million commitment. It can be applied towards 10% of the purchase price, and that capital is used to acquire furniture, fixtures, and equipment, FF&E. What this does is it provides us with a unique competitive advantage to acquire approximately $500 million of hotels at returns better than what we otherwise would have been able to acquire because the reduction of the equity commitment that we need to make. Now, what this is intended to do is to make good deals great deals. And so far, we've acquired just over $400 million of hotels, utilizing about 80% of the ERFP, or Enhanced Return Funding Commitment. So we definitely believe this gives us a strong competitive advantage in pursuing the limited number of transactions that are still in the market today.
And what are you anticipating in terms of dispositions over the next 6 to 12 months? And how does the gap between public and private valuations play into that?
Well, there's definitely a gap between public and private valuations today. Public companies are trading at a discount to NAV, and I think that that's generally because when economic conditions start to change in the market, the first to be affected is the publicly traded companies. The private values tend to hold up a little bit longer, and clearly I think that with some concerns about which direction the economy is going, up or down, that uncertainty is something that's not comfortable for investors. But in the private market transaction, it's a very healthy market still in terms of trading activity, even though there's a slight decline. Now, that slight decline in terms of sales may be a function of the fact that buyers want to hold on longer because they're not certain which direction the economy is going, or they may want to sell because they want to be on the front end of a slight economic decline. Either way, it's an active market, but just slightly down from last year. Now, when it comes to asset sales for us, our asset sales are financially calibrated. We are not looking to sell just for strategic reasons. We're looking to sell for economic reasons. And what we've done so far is we've sold about $375 million of hotel assets since 2015. And those assets had an overall RevPAR of about $80, which was materially lower than the portfolio RevPAR that we have of approximately $120. So what we're doing is we're culling some of the lower RevPAR, less strategic hotels. But what's great about the trades that we made is that the cap rate that we sold these assets for was approximately an 8.1% trailing 12-month cap rate, or an all-in cap rate of 6.9%, which is a lower cap rate, much better value than what our portfolio was trading for at the time that we sold those properties. So we think we executed extremely well. It highlights the fact that there's significant embedded value in our portfolio that we feel really isn't being necessarily recognized by the public market today. And so in terms of future potential asset sales, we're going to be very strategic and very opportunistic about that on a go-forward basis.
Doug, thanks so much for your time today.
Thank you very much.
For more on NAREIT's REIT Week, visit REIT.com.